Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Tuesday, May 26th, 2026, and we're seeing some notable market movements as geopolitical tensions shift and investors reassess their positioning. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. Well, the dominant story continues to be the evolving situation with Iran. We've seen US forces conducting what they're calling self-defense strikes in Iran. But interestingly, there's growing optimism around potential peace deal negotiations. This has created an interesting dynamic in the oil markets where we saw prices strengthen initially after the attacks. But then we're seeing crude pull back as peace deal hopes gain traction. That's directly impacting energy stocks, with ConocoPhillips rallying on the initial oil price surge. Beyond geopolitics, we're seeing some significant corporate governance issues making waves, particularly BP, removing Chairman Albert Manifold over what they're calling serious concerns about his conduct. That's causing European stocks to decline and BP shares are taking a hit. On the earnings front, it's a mixed picture. We've got companies like BJ's Wholesale planning major store changes as they're seeing customers pull back, which speaks to broader consumer concerns. Abbott Laboratories is sliding on nutrition business headwinds, but on the positive side, Eli Lilly stock edged higher on news of nearly $4 billion in planned vaccine deals.
That's quite a range of developments. The geopolitical situation seems particularly fluid right now. What does this mean for traders and investors navigating these crosscurrents?
The key here is understanding that markets are trying to price in multiple scenarios simultaneously. For energy traders, this volatility creates both opportunity and risk. If peace deal momentum continues, we could see further pressure on oil prices, which would be bearish for energy stocks, but positive for consumer discretionary names that benefit from lower fuel costs. The corporate governance situation at BP is a reminder that company-specific risks can emerge suddenly and impact even the largest firms. What I'm watching closely is the broader market reaction to these geopolitical developments. We're seeing Treasury yields influence rate cut expectations, which is affecting flows across asset classes. The corporate earnings picture suggests we're in a period of increased selectivity. Companies facing consumer pullback pressures are getting punished, while those with strong deal flow or pricing power are holding up better for the indices. Let's look at the technical picture. The S&P 100 is showing resilience near recent highs, but we're seeing some divergence in breadth that suggests caution. Support sits around the 2,850 level, with resistance at 2,920. The Nasdaq is benefiting from strength in select tech names, trading in a range between 18,200 and 18,600, with the AI theme still providing support for certain sectors. The Dow is actually showing relative weakness given the pressure on industrial and energy components, with key support at 39,800 and resistance at 4,500. The index is caught between conflicting signals from the geopolitical situation and domestic economic data.
That selectivity you mentioned seems critical in this environment. How should investors be thinking about sector rotation given these dynamics?
Sector rotation is really the story right now. If we get a genuine de-escalation in Iran, that's bearish for energy, but potentially bullish for industrials and consumer discretionary. The challenge is that the situation remains fluid, so we could see these rotations reverse quickly. What's interesting is the corporate bond market, where the Wall Street Journal is pointing out that bonds look like a great deal on the surface. But there are concerns if you look more closely at credit quality and duration risk. That suggests investors need to be careful about chasing yield without understanding underlying risks. The pharmaceutical sector is showing some resilience, with Eli Lilly's vaccine deal highlighting that healthcare deal activity remains strong. But the Abbott Laboratories weakness shows that even within healthcare, you need to be selective. Companies with exposure to discretionary health spending or consumer-facing businesses are more vulnerable than those with essential products or strong institutional demand. For traders, the volatility around geopolitical headlines creates intraday opportunities, but the risk is getting caught on the wrong side of a headline-driven move.
Those are practical insights for navigating what's clearly a headline-driven market. Let's shift our focus now, Steve. What's the economic picture telling us? What data should we be watching?
Thanks, Robert. We're in an interesting period where the economic calendar is relatively light this week, but the data we do have is providing important context for the Fed's thinking on rates. The Treasury yield dynamics that Lizzie mentioned are critical because they're essentially doing the Fed's work for them by tightening financial conditions without the central bank having to act. We saw consumer confidence data earlier this month that showed some softening, which aligns with the retail pullback that companies like BJ's Wholesale are experiencing. The housing market data has been mixed, with existing home sales showing weakness, but new construction holding up better than expected, suggesting builders are adapting to the higher rate environment better than the resale market. Looking ahead to the rest of the week and into early June, we've got some important releases coming up. The second estimate of first quarter GDP is due Thursday, and economists are expecting it to be revised slightly lower from the initial reading, which would confirm the slowdown narrative. We're also getting personal income and spending data for April on Friday, which will give us insight into whether consumers are maintaining their spending despite the confidence pullback. The core PCE price index, which is the Fed's preferred inflation measure, comes with that report and is critical for rate expectations. Current forecasts suggest inflation remains sticky above the Fed's 2% target, which is why those Treasury yields are staying elevated and why rate cut expectations keep getting pushed back. The employment situation remains relatively solid based on the most recent data, with jobless claims staying low, but we're watching for any signs of softening that would give the Fed more flexibility to cut rates.
That inflation persistence seems to be the key constraint on Fed action. How are you reading the balance between growth and inflation risks right now?
The balance is definitely tilted toward inflation concerns at the moment, which is why the Fed has been able to stay patient. The growth picture is showing some deceleration, but we're not seeing recessionary signals in the hard data yet. What's interesting is the divergence between different sectors of the economy. Manufacturing has been weak for months, with ISM manufacturing staying below the 50 expansion threshold, but services have held up much better. That creates a challenging environment for the Fed because the service sector is where most of the employment is, so as long as services stay resilient, the labor market stays tight, which keeps upward pressure on wages and service sector inflation. The geopolitical situation adds another layer of complexity because if oil prices spike on escalation, that feeds through to headline inflation and consumer psychology, but if we get de-escalation and oil falls, that provides some disinflationary relief. The Fed's challenge is distinguishing between transitory moves in commodity prices and persistent underlying inflation pressures. Based on the most recent Fed minutes and commentary from officials, they seem comfortable waiting for more evidence that inflation is sustainably moving toward target before cutting rates. That means, unless we see a significant deterioration in employment or growth data, rate cuts probably remain a third or fourth quarter story rather than something imminent.
That patience from the Fed certainly shapes the investment landscape. Lizzie, let's talk about crypto markets. What are you seeing in terms of trends for Bitcoin, Ethereum, and Solana heading into next week?
The crypto market is facing some significant headwinds right now, and the trend for next week looks cautiously bearish across the board. Starting with Bitcoin, we're seeing some concerning signals. Swissblock has identified Bitcoin in what they're calling a high-risk zone, and we're seeing massive ETF outflows as institutional investors rotate out of crypto. Bitcoin is trading in a range between $76,500 and $77,000. But the demand gauge has hit its worst levels since December. What's particularly notable is that we saw a Satoshi-era Bitcoin miner transfer, $203 million in BTC to OTC desks, and Trump Media moved 2,650 Bitcoin, which suggests large holders are distributing. The volatility has fallen to 8-month lows, which historically can precede a breakout, but given the weak demand metrics, that breakout could easily be to the downside. For next week, I'm looking at a range of $72,000 to $78,000, with a bearish to neutral bias. The positive factors are the improving geopolitical situation and the upcoming Nasdaq Bitcoin options launch, but those are being outweighed by the institutional selling pressure and weakening spot demand.
Those institutional outflows are significant. What about Ethereum and Solana? Are they showing similar patterns?
Ethereum is actually looking worse than Bitcoin from a technical and fundamental perspective. The price chart is targeting $1,800 as total value locked in DeFi hits 13-month lows. That's a significant warning sign because TVL is a key measure of actual usage and activity in the Ethereum ecosystem. What really caught my attention is that a major whale opened a $100 million short position despite Vitalik Buterin's recent commitment to sell less ETH. When you see that kind of positioning from sophisticated players, it tells you the smart money is betting on downside. Ethereum is currently around $2,100, and I think we could see a range of $1,900 to $2,200 next week, with a bearish bias. The Ethereum Foundation announced they're shrinking and focusing on what they call the SOROPS initiative, which is a strategic shift but doesn't provide near-term price support. Solana is showing technical weakness with a bearish crossover formation that suggests potential for a drop below $80. There's been limited news flow around Solana compared to Bitcoin and Ethereum, which indicates reduced market attention. When assets lose mindshare, they tend to underperform. For Solana, I'm looking at a range of $75 to $85 next week, and that $80 level is critical support. If it breaks, we could see accelerated selling.
What about the institutional versus retail dynamic in Bitcoin specifically? How are those two groups positioned?
That's where the story gets really interesting and somewhat concerning. The institutional side is clearly in exit mode. We're seeing billions in outflows from Bitcoin ETFs, and firms like Swissblock are warning clients about high-risk zones. The ETF outflows are particularly significant because those products were supposed to be the bridge bringing traditional finance into crypto, and instead we're seeing that bridge traffic moving in the opposite direction. The institutional rotation appears to be driven by Treasury yields, making traditional fixed income more attractive on a risk-adjusted basis, and also by concerns about regulatory uncertainty and the lack of clear catalysts for crypto in the near term. On the retail side, it's more mixed. We're seeing some retail investors buying dips, particularly in alternative cryptocurrencies and what are being called hype funds, but the overall retail engagement seems lower than during previous bull cycles. What's notable is that retail seems to be chasing newer, more speculative tokens rather than accumulating Bitcoin, which historically has been a late cycle behavior. The combination of institutional selling and retail speculation in lower quality assets is generally not a healthy market structure. For Bitcoin to establish a sustainable uptrend, we'd need to see institutional demand return, which likely requires either a significant price correction that creates value or new fundamental catalysts like clearer regulatory frameworks or renewed corporate treasury adoption.
Well, that gives us a comprehensive picture of where we stand across markets, economic data, and crypto. As always, remember to do your own research and consult with financial advisors before making investment decisions. The markets are complex, and what we've discussed today represents analysis and perspective, not specific investment advice. Thanks to Lizzie and Steve for their insights, and thank you for listening to The Morning Bell. If you found today's discussion valuable, please subscribe to the podcast so you don't miss our daily market analysis. We'll be back tomorrow with another edition. Until then, trade carefully.